The Indian government is considering a major change to its tax system. It may remove all exemptions under the old tax regime. This change is expected to be part of the upcoming budget 2025. If implemented, all taxpayers would transition to the new tax regime. This move is significant. It aims to simplify the complex tax system in India. The old tax regime, with its many exemptions and deductions, can be confusing. The new regime offers lower tax rates but with fewer benefits. The government hopes this will make it easier for people to understand and comply with tax laws. The proposed change is driven by several factors. Firstly, it aims to simplify the tax system, making it easier for taxpayers to understand and comply. Secondly, it seeks to improve tax compliance. A simpler system with lower rates might encourage more people to pay their taxes honestly. Lastly, it aims to boost consumption by increasing disposable income. Lower tax rates could leave individuals with more money to spend. The potential impact on government revenue is a subject of debate. Some experts believe it could lead to a slight decrease in tax revenue. SBI Research estimates a potential revenue loss of 50,000 crores. This loss is equivalent to 0.14% of India's GDP. However, the long-term benefits of increased compliance and consumption might offset this initial loss. The government is proposing several changes under the new tax regime. One significant change is the consolidation of all existing exemptions. This means that benefits like house rent allowance and leave travel allowance could be subsumed under the new system. Additionally, the government plans to adjust tax rates and limits. The NPS limit is expected to increase from 50,000 to 1 lakh. The medical insurance exemption under Section 80D could rise from 25,000 to 50,000. The peak tax rate of 30% for income above 15 lakh is likely to remain. However, the tax rate for income between 10 to 15 lakh could be reduced from 20% to 15%. A flat 15% tax might be implemented on bank deposits added to other income, not in the highest bracket. Finally, the tax exemption limit for savings account deposits may increase to 20,000. The new tax regime was introduced in the 2020 Union Budget. It offered lower tax rates than the old regime. However, it did not include many of the exemptions and deductions available in the old system. Many taxpayers continued to prefer the old regime. They found the deductions, such as those under Sections 80C and 80D, more beneficial. Experts have expressed support for transitioning to the new tax regime. Dr. Soumya Kanti Ghosh from SBI believes it can ensure better compliance and boost consumption. Vivek Jalan of Tax Connect Advisory Services LLP sees it as a logical step towards simplification. Balwant Jain, a tax and investment expert, believes the government's bias towards the new regime makes the removal of the old regime likely. The proposed changes signal a potential shift in India's tax landscape. While there might be an initial impact on revenue, the long-term benefits of a simpler and more transparent tax system are clear. It remains to be seen how these changes will play out in practice and how they will impact taxpayers in the coming years.